G'day and welcome. Let's imagine that you've just gotten to the pointy end of doing your negotiations to have a look at buying your first commercial property or commercial business, and they've handed you a profit and loss statement. I bet you in the next 15 minutes I can teach you everything you need to know on how to pull the profit and loss statement apart so that you can be assured that what you're buying is actually going to make you money. G'day, I'm Peter Bender and you've joined us on the Bundaberg Commercial Realty YouTube channel. So having a look at a profit and loss statement, you'll find the first part is all about income. And we're just going to focus on this particular profit and loss, which is a real one from a client. I've sanitized it so you can't tell who it is. So we're going to look at the 2021 figures for this one. Now this client is a specialist repairer of commercial vehicles. And they also have a large showroom which sells a lot of material. So you'll find that their income comes in two particular areas. And for companies that have a fair bit of stock on hand, you will find that they have almost two profit and losses. The first part is what they call the trading income. So you can see here for 2021, this business made almost $1 million in sales. Now they're the sales when their vehicles have gone out to customers' properties, fixed the trucks that they need to take care of, and issued an invoice. To keep things a little bit simple, they want to work out from an accountancy point of view how much of the business is actually spent on getting that main part of the sales. So it's basically what we call the cost of sales or the cost of goods sold. You'll see here they've got opening stock and they've got purchases. So at the end of the financial year last year, they had $117,000 worth of bits and pieces. And during the whole year, they had purchased $629,000. And then there's $30,000 worth of freight. So that's essentially the stock that's coming in and out. And then they have a closing stock figure, which gives you a total cost of sales. So for that $1 million, it cost them almost just over $500,000 to produce that income. And the difference is what you call the gross profit. And quite often you'll measure gross profit as looking at 437,000 divided by 999,000. So that's round about 60% profit, which is really good. And that's a gross profit margin. If we go to the next stage, we talk about a more traditional profit and loss setup. In here you see that 437,000, which was carried over from here, remember from the first page. So that's a gross trading profit. And now we're going to have a look at what it costs to run the rest of the business, things like rent and wages and everything else that is included, but was outside the scope of how much it actually cost to repair those trucks. So you got the cost for repairing the trucks, the profit they had, which is 437,000. Now they've also sold a lot of bits and pieces, which is 230,000. You've got a few extra bits of income. So this first part here is all about the income of the business. So the money that comes into the business. And usually there's a main source and maybe 2 or 3 subsidiary sources. And you'll find most of it will be in those 2 sources. So the 437 and the 231, that's almost 90% of the income they have. The other bits are small. You've got government payment. Now that could be for apprentices or wage subsidies, interest received. If they've got money in the bank while they're waiting for the BAS statements to come in, could be in that bracket. Rebates and refunds. That could be from suppliers if they hit particular thresholds. And a cash flow boost subsidy. Now this was during the time of COVID when our government was supporting businesses by giving subsidies for business owners to hold on to their staff rather than letting them go during COVID. So all up, that business in 2021 made $700,000. That sounds pretty good. But now, like a household income, that would be your wage that you made. Now we've got to look at the other side, which is the expenses. These are the outgoings. So what did it cost to run this business? All right, so going through them one by one, you've got accountancy. That's pretty self-explanatory. For most people, that's usually just their BASs and their annual returns. Some businesses may have a large amount for accountancy where their accountants may be having a role like a business advisor. Other times they may be small because they just don't see their accountant much at all. Advertising and promotion. That's always a good one to have a look at. You may find that there could be one particular area of advertising and promotion. Maybe they do Google advertising and that's $15,000. So that's a good one if you're buying a business in particular, just to drill down a bit more and ask them what is involved in the advertising and promotion. Bad debts. Okay, in this instance, once again, remember it was COVID. So they may have had a supplier or more likely a customer who's gone out of business and they're not going to get that money back. So they've taken that as an expense. You'll notice when we go and have a look at the year before, there wasn't any bad debts. So that's a one-off thing, but it's something to take note of. Bank fees and charges, bookkeeping fees. So this client has a bookkeeper that does their books and then they send the raw statements to the accountant to do the bits and pieces. So that explains why the accountancy may be a little bit low, because I've actually got two accountants in one way to look at it. Rubbish removal, computer expenses. Okay, now here's an interesting section. This is called depreciation. I won't go into too much detail with it, but when you buy a significant piece of plant, like it may be a machine, it may be a truck, it could be anything in that sort of aspect, it could be a large scale computer setup, you're able to account for that from a taxation point of view in one or two ways, depending on the tax laws at the time. The tax law may allow you to put the whole lot onto your expenses for that year, and that's what you call an instant asset write-off. Or if it's above a particular threshold and that threshold changes on a regular basis, you need to what they call depreciate it. And it may be something that gets depreciated over 10 years. So you get to take that expense at 10% each year. All right, so what does that work in reality? Let's say you've bought, for argument's sake, a truck and it's $100,000 and you can't use it as an instant asset write-off, you've got to depreciate it. So each year you'll take $10,000 and you'll put it in depreciation. That's not a cash expense for you, but it's just the way that accountants and the taxation office allows you to claim that back as an expense. If it was something smaller like a work vehicle that was $25,000, you may well be able to claim the whole lot back as an instant asset write-off. The depreciation goes more into the realm of accountants, but it's just wanted to make sure that you got a short understanding of it. So depreciation other, now that's interesting. So they've got like 18,000. I would ask them what that is. If it's not plant and it's not building, it may well be a vehicle. It could be, like I said, computer software, something like that you need to have a look at. Donations, it's good to see they put something back into the social infrastructure world. Electricity, sometimes you'll get used to understanding what is normal for electricity. You'd also, as you go and look at the business, just have a look on the roof, see if they've got solar or not. That quite often answers a question on electricity. Fees and charges, it's a small amount, so I wouldn't sweat the small stuff, don't worry about it. Insurance, it's always good to have a look at the insurance policy, see what that actually covers. Does it cover building and contents? Does it cover public liability, public indemnity, director's indemnity? Make sure you get a good understanding of what the insurance actually involved. Okay, interest expense. So as opposed to interest received, this is interest expense. So they may have a loan and something in that area. So they had to pay $8,000 back on that loan. Once again, it may be they bought a truck and they've got a loan in association with that. Then you've got motor vehicles. Now this company has a range of vehicles that go out to service their clients. So once again, you've got a large amount of depreciation, which isn't too unexpected when they have a fleet of vehicles, and they may well have bought them recently. But you want to have a look at what they call a depreciation schedule. Each item on the profit and loss statement can be drilled down. So anything that's got a category, and these are all categories on the left-hand side, if you want to ask them, you can say, look, I want to see what compiled the 34,000 in vehicle depreciation. It's just a matter of pulling another report and let you know. And this is the stuff that your accountant will do. When you look at a profit and loss, it gives you an idea, and we're just going to give you that raw nuts and bolts approach. But when you get into due diligence, what happens? Your accountant talks to their accountants, they swap electronic files together, and they both pull things apart and talk to each other and come back to you with basically an answer. Fuel and oil is pretty self-explanatory. Motor vehicle interest, so it sounds like they've got a leasing arrangement, or maybe a personal loan on a vehicle, registration and insurance, repairs. Now that, once again, depends on how much mileage is going through on a vehicle and what type of vehicles you've got. That's $24,000 is a reasonable size, so you might want to have a look at that. Maybe one of them had an engine rebuild or something along that bracket. So once again, you can ask them to give you the drill down on that particular figure. Motor vehicle other at $800, I wouldn't worry about. Postage, I'm surprised people still use postage. Printing and stationery, okay, that could be for invoices, the likes of that, could be brochures. Sometimes printing and stationery is mixed in with advertising and promotion, but if it's a figure that you want to have a look at $13,000 might be. You want to ask for it and get a drill down on that one. Rent on land and buildings. So this is a situation where the business owner rents property. Other times you can have a business owner that also owns property and pays rent to themselves by way of a superannuation fund. You probably just want to make sure that it is a market rate, and that could be a little bit of homework for you, but it gives you an idea if you've got a really good rate or if you're actually looking at paying more than what you would normally do. And that will help you decide when it comes time to taking the contract. You can either get the lease assigned, which means they take the owner's name off and put your name on, or you can get a new lease totally, in which case you renegotiate terms and conditions in regarding options, how long you have it, and the price and outgoings with the landlord. Repairs and maintenance, not a big amount there. Replacement tools, to me that looks a little bit low actually, considering I know the business. I would have expected that tools would have cost more for that. Now here's a good one, salaries associated persons. Now there's different legal structures. There's trusts, there's proprietary limiteds. In this instance, this company is a proprietary limited. There's sole traders and there's partnerships. Now each one of those have a different way of reporting wages or drawings from the owner. In this particular instance, it's nice and easy to see the owners have taken $105,000 out last year. That's what they pay themselves as a wage. Sometimes if you don't see associated persons, you just get wages and expenses, you need to ask the person who gave you the profit and loss to identify and tell you how much the actual owners got paid. If it's drawings, it'll be in another sheet. It'll be called on the balance sheet and we can see that. But for the likes of this particular purpose, you just want to try and identify where is it that the owner got paid and how much did they get paid. All right, rolling right along. Security, staff amenities, that's probably toilets and kitchens. Subscriptions, they may be for associations and the likes of that. Superannuation. Now, in this instance, I would have expected to see superannuation for associated persons. So that is the superannuation paid for the owners. Quite often it may be the owners don't pay themselves superannuation, or it may be that it's included in workers' superannuation. So you need to just clarify that. Telephone, $12,000 for telephones, that sounds a little bit high. I know they've got probably mobiles for all the people that go out. They've got IT systems that may be included in that, because it doesn't look like IT separated out there. Once again, at $12,000, I'd probably get them to drill down and let you see what it is. Travel, accommodation and conferences, not much there. Uniforms, wages, all right, that's a big part for this particular business. You can get payroll reports, and the good thing with payroll reports is it tells you the position of the person who's doing the wages. It tells you the hourly rate. It tells you when they started. Gives you a bit of indication on turnover, how experienced the workforce is, if they have to pay them above award, if they're paying them on award, that type of information. Workers' compensation, that's just to make sure that you're insured in case there's injuries. So that gives you total expenses. So it's $500,000 in total expenses. Now, remember this business, when we started, they had $1 million worth of sales plus another 200. So you would think that 144,000 might be a little bit low. That's about 15% of the net profit is about 15% of the revenue. A good business holds around 20%. Now, we're going to have a second look through here, and we're going to now do some additions and some subtractions to give us what it actually means from a cash point of view. What we're looking at here with a profit and loss is a taxation point of view. And businesses generally try to have a small number down here in the profit and loss because that means they pay less tax. But it may not be an accurate figure for someone who's coming in to buy the business. What you want to know is how much money was in the bank at the end of the day for the year that business had. So if we went back through here quickly, there's not much change. You wouldn't change much in the gross profit section. You would remove things like the cash flow boost subsidy because that was over 1 or 2 years. So next year they're not going to get that 30,000. So you would actually take that off the 144,000 net profit. So suddenly they're at 110. But don't panic just yet. We work both ways. We'd have a look at, I'd leave the bad debts there. All right, depreciation planned. So you would add that to the profit because that wasn't actually a cash aspect. So they've just made that to reduce the tax, and because of the treatment, they're not dodgy. This is just the way the taxation system works. Depreciation of buildings. So this depreciation other, you would add that to the $144,000. So suddenly that looks a little bit more beneficial. You've got other things through here. Once again, depreciation for the motor vehicle, you would add that to your 144,000. And you would look at anything else in here? Rent land, salaries associated persons. So that's what they paid the owners. So the owners had that as profit. So once again, you would add that to your net profit. Superannuation, you'd find out if there's an owners section in there. If they had 8,000 for the owners, you'd add that in there. Otherwise, just leave that alone. So for the 144,000 there, if we did that quickly, you'd take off 30 for the subsidy, so that gives you 110. You'd take off the depreciation for the vehicle, so 110, 120, that's close to 130. You can work out your numbers. I'm just doing this in my head. So you got 130 there. You got another 30,000 there, so that's $170,000 maybe. And then the big kicker was this one here, so that's 274,000. So how much money did the owners actually put in their pocket? They had the opportunity to put in $274,000. When you put 274,000 divided by their revenue of a million and maybe 230 there, so that would be 174. So that's about a sixth. So that's about 18%. If you had a business that's looking at 18%, just doing this nuts and bolts aspect, you should be pretty comfortable with it. It's something that is worth having a look at more. One final thing we're going to look at is it's always good to have a look at a couple of years worth of the profit and loss. So we'll open up this spreadsheet to show you the 2020. So the things that you notice here is 2020 was a sad year. Obviously that was when COVID hit us and hit us bad. So they're starting to make a recovery in 2021. Once again, you have the cash flow subsidy, so you'd have a look at taking that out. You don't have a bad debts, so that's better. But you do have depreciation planned. So that 46,000 you would add to your profit and loss. So you'd lose 20,000, but you add 40, so you're 20 grand up. Depreciation, you've got another almost 10 grand there, so you're 30 grand up. Interest is something you take out, so that's or you add on to it because it's particularly for the person, not the business. So you're looking at about 42,000. There's no depreciation in that year. You'd have 142,000 now by the time you add their wages. So in that instance, they made probably 180,000, and that was in a hard year. For a lot of people, 180,000 in 180,000 in, that's about a quarter. So once again, the numbers are down, but they're getting close to the 20% mark. So this is a fairly solid business. It was a little bit up and down in these 2 years. Obviously, if we look now at the figures at 22, 23, 24, the figures would be much different. You wouldn't have your wage subsidies, but you'd probably have a full recovery on the business. So it's a little bit longer than 15 minutes. Sorry, I tried hard, but I want to make sure you got it all. But it should give you an aspect on how to find the income of the business and how to find the expenses of the business, and then most importantly, how to add back and subtract the items that are for taxation but wouldn't actually affect the cash flow of the business. Hope you enjoyed that. If you want me to do balance sheets, that's a little bit more complex, so leave me a comment. I don't want to do that if it's not going to be of benefit for people. Most people, profit and loss is all they need. But yeah, leave me a comment, let me know what you'd like to hear. Take care and God bless.